I caught myself doing something recently that made no logical sense, and when I dug into why, I realized millions of people are doing the exact same thing. I was scrolling through financial news and I saw that gold prices had hit another all-time high. And my first thought wasn't, oh, that's interesting. My first thought was, I should buy some, which is insane. Because I don't even like gold as an investment. I think it's boring. It doesn't pay dividends. It doesn't grow earnings. Gold just sits there being shiny. But something in my brain short-circuited when I saw those headlines, and I caught myself genuinely considering driving to a coin shop and buying physical gold coins. That feeling, that pull, that's what we need to talk about. Because gold is having another moment right now, not because it's a great investment, but because something much deeper is happening in people's brains when uncertainty rises. By the end of the video, you'll understand what that something is, why buying gold becomes trendy from time to time, and you'll make better decisions about whether gold belongs in your financial life at all. Here's what's actually going on. When things feel unstable, economically or politically or socially, people start gravitating toward gold and silver. Every single time. It's predictable. It's been happening for thousands of years. But here's the weird part. It has almost nothing to do with returns. Gold doesn't outperform stocks over the long run. It doesn't generate income. In most decades, it barely keeps up with inflation. Sometimes it doesn't even do that. I've spent way too much time watching the world suddenly want to buy gold at Costco when the world starts to feel a bit shaky. Here's what I've learned about why this happens. The answer comes from behavioral economics, and it's way more interesting than you'd think. There's this concept called tangibility bias. It's the idea that when trust in systems breaks down, people shift toward things they can physically hold, things that exist in the real world, not just numbers on a screen. And this isn't new. This is hardwired into how humans think about value. When you can hold something in your hand, when you can see it and touch it and put it in a safe, your brain processes it differently than a number in an account. It feels more real, more secure, more yours. Researchers have studied this. They call it the endowment effect. The moment you physically own something, you value it more highly than you did before you owned it. Just the act of ownership changes your perception of its worth. And with gold, this effect is massive. A gold coin in your hand feels like wealth in a way that a brokerage statement never will. Even if the brokerage statement represents way more money, this is especially powerful during times when trust in institutions is low, when banks are failing, when governments are printing money, when the financial system feels abstract and rigged and incomprehensible. That's when people want something simple, something tangible, something that doesn't require trusting anyone. Gold is that thing. You don't need a bank to hold it. You don't need the government's permission to own it. You don't need the internet to be working for it to have value. It just exists. And that existence feels like safety. There's another really interesting thing happening in your brain when you're drawn to gold. This one comes from Daniel Kahneman and Amos Tversky, the psychologists who basically invented behavioral economics. They discovered this concept called prospect theory, and it completely changed how we understand financial decision making. Here's the core insight. A loss hurts about twice as much as a gain feels good. Let that sink in for a second. If you lose $100, the pain you feel is roughly twice as terrible as the enjoyment you'd feel from gaining $100. This asymmetry changes everything about how people behave when they're scared. In normal times, when things feel stable, people are willing to take risks for growth. They'll invest in stocks, they'll start businesses, they'll bet on the future. Things are good. But when fear kicks in, the whole calculation flips. People stop trying to maximize gains and they start trying to minimize losses. And that's where gold comes in. Gold isn't attractive because it promises high returns. It's attractive because it feels like it can't disappear. Stocks can go to zero. Companies can go bankrupt. Every few years you see a large company go under. Currencies can hyperinflate. Even banks with all the money in the world can fail. But gold just kinda is. It's been valuable for 5,000 years, and here's the thing. It's not going anywhere. So when people say things like, I'm not trying to get rich, I just want to protect what I have. What they're really saying is, I've shifted away from looking to grow my wealth, and now I'm looking to prevent losses at all cost. And in that mode, in that way of thinking, gold makes perfect emotional sense, even if it doesn't make financial sense necessarily. Because here's the thing, gold is a loss minimization asset, not a profit maximization asset. And most of the time, most people don't need loss minimization. They need growth, especially if they are younger. But when uncertainty spikes, the brain doesn't care about growth anymore. It cares about one thing, survival. Let's look at when this actually happens historically. During the 2008 financial crisis, gold prices nearly doubled in 3 years. Why? Because banks were collapsing. The entire financial system looked like it might implode, and because of this, people wanted something that existed outside that system. In the 1970s, during stagflation, when inflation was running at double digits and the economy was stagnant, gold went from $35 an ounce to over $800 an ounce. People were terrified that the dollar was becoming worthless. They wanted to store value that governments couldn't print. Every time there's a currency crisis, gold spikes. Every time there's a banking panic, gold spikes. Every time trust in the system erodes, gold spikes. It's not random, it's a psychological pattern. And here's what's crucial to understand. The people buying gold during these spikes aren't thinking about returns. They're thinking about safety. They're thinking, what can't be taken from me? What can't disappear? Gold is the answer their brain gives them. Now, does that mean you should buy gold? Not necessarily, because there are some serious traps here that most people fall into. The first trap is timing. People tend to buy gold at exactly the wrong time. They buy when fear is at its peak, which means prices are at their peak. Then when things calm down and confidence returns, gold prices drop and they sell at a loss. This happens over and over. It's emotional buying, not strategic buying. If you're going to own gold, you need to own it before the crisis, not during it. You need to own it when nobody cares about it, when prices are low, when it feels boring. But that's hard. Because when things feel calm, your brain doesn't want safety. It wants growth. So most people buy high and sell low, which is the opposite of what you're supposed to do. The second trap is what I call the physical ownership illusion. And people think that owning physical gold makes them safer. And in some ways it does. You don't have counterparty risk. You're not depending on a bank or a brokerage or a government. Liquidity. If you need to sell gold quickly, you're probably not getting the best price. You have to find a buyer. You have to verify authenticity. It's not like selling a stock with one click. But who does that? Because when things feel calm, your brain doesn't want safety. It wants growth and gains. We want to see the numbers in our account going up like all of our friends. So most people buy high and sell low, which is the opposite of what you're supposed to do. And what about opportunity cost? Gold doesn't generate income. It doesn't compound. If you're holding $10,000 in gold for 10 years, it's still just $10,000 worth of gold, maybe more, maybe less. If you'd invested that $10,000 in an index fund, it could have doubled or tripled in that time. So yes, physical gold gives you a certain kind of security, but it also comes with costs that erode your wealth over time. The third trap is the inflation hedge myth. Everyone says gold is an inflation hedge, and sometimes it is, but not always. In the 80s and 90s, inflation was relatively moderate, and gold prices went basically nowhere for 20 years. If you bought gold in 1980, you didn't break even until the mid-2000s. Gold protects against extreme inflation, or complete currency collapse, or loss of faith in the system, but it doesn't really reliably protect against normal inflation. Stocks are the thing that protect against normal, stable inflation. Real estate, businesses, things that generate cash flow and can raise prices. A little bit of inflation one year, raise the rent on your tenant $50. So if your goal is just to keep up with inflation, gold might not be the best bet. If your goal is to have something that can't disappear when the system breaks down, then gold starts to make more sense. See the difference? That brings us to why gold feels so different right now. We're living in the most financially abstract era in human history. Most money isn't physical anymore, it's numbers on a computer screen, and those numbers are controlled by systems most people can't wrap their heads around. Derivatives, leverage, algorithmic trading, carry trades, the stuff that gave me nightmares on my college financial economics exams. These aren't things normal people can intuitively grasp. They're complex, and they create a ton of underlying anxiety. When you don't understand how something works and your financial security depends on it, that's stressful. Gold is the opposite of that. It's simple. It's been valuable forever. You can understand it. A 5-year-old can understand it. You're probably wearing some right now. And in an era of increasing complexity, that simplicity is psychologically powerful. Then you add in the occasional banking crises, community banks, major institutions, large and small, and they collapse almost overnight. And then you start asking yourself, wait, can my bank fail? Can my deposits disappear? Am I going to have to go ask George Bailey for my money? Technically, yes. Most deposits are insured up to $250,000, but if you have more than that, or if the entire banking system is under stress, things get complicated fast. There's been countries where the government literally froze bank accounts and took a percentage of people's deposits to bail out the banks. It's called a bail-in, and it's terrifying if you're the depositor. That kind of event drives demand for assets that you can hold and are outside the banking system. And gold is the most obvious one that comes to everyone's mind. So when you hear someone say, I want some gold just in case, what they're really saying is, I want something that doesn't require the system to keep working. That's not crazy. That's a reasonable hedge against system failure. The question is, how much? And this is where most people get it wrong. They either own zero gold because they think it's silly, or they go all in like it's some poker game because they think the apocalypse is coming. The smarter approach is somewhere in the middle. Think of gold as insurance, not as an investment. You don't buy insurance hoping to make money. That would be silly. You buy insurance hoping you never need it, but knowing it's there if things go wrong. Most financial advisors suggest anywhere from 5 to 10% of your portfolio could be in gold or other precious metals if you want that kind of insurance. Some people go higher, some go lower. It depends on your risk tolerance and how much you value that psychological safety. But here's the key most people miss. If you're gonna own gold, own it consistently. Don't try to time it. Don't buy it only when you're scared, because by the time you're scared, everyone else is scared too, and prices are already high. You're late to the party. Own it as part of your overall strategy, rebalance it, and adjust how much you own periodically, and treat it like insurance. We need to talk about what gold actually is psychologically. It's not really an investment, it's mental infrastructure. It's a valve that releases anxiety. It's a way to tell your brain, okay, I'm protected against the worst case scenario. Now I can stop worrying and focus on building wealth in other ways, and that has value, real value. If owning 5% of your portfolio in gold lets you sleep better at night, and that better sleep helps you stay disciplined with the other 95%, then gold is doing its job. I call this the sleep at night premium. You're paying for peace of mind, and that peace of mind has a price. Only you can decide if that price is worth it for you. For some people, it absolutely is. For others, it's not. If you're young, if you have decades until retirement, if you're comfortable with market ups and downs, you probably don't need gold. You might be better off invested in stocks, real estate, and businesses that grow over time. But if you're older, if you're close to retirement, if you've lived through multiple financial crises and you know how it feels when the system wobbles and you think you might crack and do something stupid, then having some gold might make sense. It's not about the returns, it's about the psychological buffer. Here's the tension that nobody talks about though. Diversification also reduces risk. If you own a mix of stocks, bonds, and real estate, you're protected against any one thing going to zero. Statistically, that's just as safe as owning gold, maybe safer, but it doesn't feel the same. And that's the whole point I'm trying to make. Gold feels different because your brain processes physical assets differently than abstract ones. Your analytical brain knows that a diversified portfolio is fine, but your emotional brain wants something it can hold. And in moments of high stress, the emotional brain wins. Always. That's not irrational, that's human. The trick is knowing which brain is making the decision and deciding consciously whether you want to listen to it. If you're buying gold because you've thought it through, you understand the trade-offs, and you've decided it fits your strategy with your advisor, great. But if you're buying gold because you're panicking, because everyone else is buying it, or because you saw some scary headline and you just need to do something because you're tearing your hair out, anything, to feel like you're in control, then pause. Because that's the trap. That's how you buy at the top and sell at the bottom and become a meme on some Wall Street Bets post. So here's the truth. Gold isn't magic. It's not a secret wealth hack. It's not going to make you rich, but it's also not stupid. It's a tool. And like any tool, there's a time and a place for it, and it works if you use it correctly. If you want to own some gold as a hedge against system failure, as a psychological buffer, as a way to diversify away from purely digital assets, that's reasonable. Just be honest about why you're doing it. Are you doing it because it fits your long-term strategy, or are you doing it because you're scared? If it's for strategy, great. If it's fear, take a breath and think it through. The best financial decisions are made when you're calm, not when you're panicking. And gold is going to be there either way. It's been here for 5,000 years. It'll be here tomorrow. The question isn't whether gold is valuable. The question is whether it's valuable to you right now, given your goals and your situation, and only you can answer that. If you found this helpful, let me know in the comments if you own any gold and the best hiding places you've thought of, and give this video a thumbs up. I'm curious to know how people are thinking about this. And if you want to keep building wealth in ways that actually compound over time, check out the next video where we'll talk about assets that grow.